It seems like everyone I know has been bag holding one stock for the last 6 months, worse than any other bag holding in recent history. And that stock is none other than Intel. Now, it's not that Intel has gone down per se, but over the last 6 months, with the insane rallies and so many of the other things that these same people were analyzing, it just seemed like Intel could not keep up. And that is until today, where Intel has finally seen some movement with a 9% rally on good news that the CPUs they've put out are performing better than expected. So I'm really happy for everyone who's been long the stock, but obviously the question that we're here to discuss together today is, where's the trade now? Is there an option position that I can be putting on? How did volatility react to this news? And what is the next move here? So I do have a position that I'll be putting on today for Intel, and I'll break down for you in this video the exact analysis that I've used to place this trade. Now, if you're new to the channel, my name is Sean Ryan. I'm the CEO of Predicting Alpha. We focus on boring option selling strategies that actually make money. It's a closed private community for serious option sellers who are just ready to start trading with an edge. If you want to learn more about it, you can click the links in the description. There's a free course there that teaches you everything about option selling, and there's a link to take a free trial with us if you're interested. All right, so taking a quick look here, here is the article that I read about the news that came out. INTC being up 6% following the release of new benchmarks for its chip, showing promising performance, yada, yada, all good. Whole point that I care about here is news article came out, market reprice stock go up, makes sense, that's great. Now, the reason I leave it at that is when I'm looking for a change in volatility, which is what will drive my option position, I just want to know that there is actually a reason for this change in vol. I want to understand who's on the other side of my trade. So for example, now that we know there's been a lot of positive news and we know there's a lot of retail interest in this stock, I expect to see a little bit of call skew maybe. I expect to see vol increase in the short and medium term even, because people are just buying options, leveraging up a bit. And if I do see these things, I will be looking to sell some options here because it makes sense to me that, hey, stock should rally on positive news, but should stock continue to rally, or should stock, go back down 10%? Probably not. So let's take a look at what the data shows us here and see if there's actually a position to put on. Now that we know the news, we'll come over to Intel Corp here. And the first thing that I want to point out is that on average, the variance risk premium here is actually negative. So without a real reason to be selling vol, I don't think I would be doing it here. What do I mean is I'm not rolling a short position on this in perpetuity. I'm trading a specific opportunity or vol mispricing if I'm taking any trade at all. But if I scroll down, I can also see that for the last little while, it has had a positive variance risk premium, which is pretty cool. So, in the short term, there has been a gap between that implied and realized volatility, which means, selling options has worked out pretty well over, let's say, the last 2 months or so. Now, the main number that I'm actually interested in here is this implied volatility number. So implied volatility has moved up 12% compared to where it was yesterday, meaning that even though the stock has reacted to the news now, the market is still implying that there will be more movement in the near future, let's say over the next 30 days, compared to what we were anticipating it to be just yesterday. Right, this positive news has basically brought more momentum that people are anticipating the stock to continue to rally. And we're going to basically analyze how big of a move that's actually implying and whether or not we want to be trading it. So next up, let's just take a look at how the term structure for, let's say, 30-day options has changed since last week. Right, we look here, we're going to compare Feb 7th to Feb 11th, and we're looking at the 30-day options. And the major thing that we can see here is that the level of volatility across the board is up 7 points of vol. And the next thing I'll point out, if we look at this skew time series here, is that we went from having a relatively flat skew, meaning out of the money calls and out of the money puts were being priced pretty similar, to now having a call skew, right? And minus 1.5 skew means there's a higher implied volatility for the out of the money calls compared to the out of the money puts. Now, the reason this is interesting to see is because stocks like this really shouldn't have call skew. Right? This is a big enough company with enough option volume flowing through it that it should follow a typical skew structure that we would see for a stock, where maybe the out of the money puts are more expensive than the out of the money calls, because stocks tend to move up like an escalator and down like an elevator. The increase in volatility should be to the downside. The out of the money puts tend to be more expensive. But in this case, we're actually seeing that the out of the money calls are what have been more expensive. And this has really been a phenomena in the last 3 weeks or so, with vol ticking up on the call side more than the put side. This is once again an indicator to me that the interest, the people who are on the other side of my trade, if I go to sell options here, are likely retail traders in a lot of cases. A lot of this increase in volatility is likely driven by retail speculation on the stock moving up or down in the near future. And I would actually argue that this is the most important thing to consider when we're looking at a trade. Who is on the other side? I don't want to be trading against someone more sophisticated, a insider, for example, or, some quantitative trader. If there's someone who just wants to speculate on the direction of the stock, wants to use options to leverage, and doesn't really care whether they pay, $1 or $1.10 for an option, this is the type of person who I want to be on the other side of the trade from, because I can use my understanding of volatility to hopefully make a better decision. So already off the bat, this is looking like a pretty good trade. We're keeping things simple here. Vol looks high. Right, we've seen a spike in vol post a release of information. We have a good idea that it's retail traders on the other side. This is the most trending stock of the day. Vol is up, call skew is up. There's lots of reasons to think that retail traders are driving up some of the vol here. And the last thing I want to do now is just check two things. One, what expiration should I be selling? And two, where's earnings? Is there an earnings event coming up? Because my view right now is on non-event volatility. I don't really have an opinion about earnings. And so I want to avoid trading through an earnings event if at all possible. So let's hop back onto the computer here. We'll go over to the term structure page. And using this chart here, what I have plotted right now is for today's term structures, I have the event and non-event term structures plotted. What this means is it's showing me an implied volatility less earnings related volatility. So if the lines are the same, that means there's no earnings event being priced in. And if the lines are different, then it means there is an earnings event. So what we can see here is that no earnings is being priced in the next 60 days or so, but there is an earnings event being priced in the next 90 days. So if I'm selling somewhere around the 30-day mark, that's probably a good place to be, 20 to 30 days. We can see that right now the term structure is in backwardation, right? The shorter dated options are more expensive than the longer dated stuff in implied vol terms. So somewhere between like maybe 10 and 30 days is the range where I'll be selling options here. That's pretty much the extent of the analysis that I'm going to be doing to at least get a little bit of size on for this trade. Now, there's one last question before I actually pull the trigger on a position, which is what structure should I be using? And there's really two that I'm considering. A strangle, which is basically selling an out-of-the-money call and an out-of-the-money put, or I'll be selling a bull put spread, which is, you can think of it as just half of that, where we're going to be selling the out-of-the-money put, but then we're also going to be buying a hedge even further out of the money, just in case the stock, for some reason tanks 50%, right? It's just some disaster insurance to protect our position. So let's hop over to the option chain for INTC and take a look at what is available to us. All right, so here we are on the option chain for INTC. I'm looking at about 17 days out right now. This is the range that I'll likely be looking to sell in. Now, I think the structure that I'm actually going to be going with is a bull put spread here. And what I'll likely do is sell the 20 strike put, right, which I can get about 40 cents for. And then I'll be buying the 17 strike put, which will cost me maybe 4 cents. So I'll net 38 cents in premium for this position, and my break even will be at $19.62, right? Something around that. With the stock trading at $21.41 right now, that gives me a pretty solid buffer, maybe about 10% or so, between my strike and or my break even and the current stock price. Realistically, some good news just came out. I think it's a natural reaction that the stock has seen a bit of a rally. I do expect it to chop around a bit, but I think it's entirely reasonable to think that it stays above that $19.60 mark. And even if it goes a bit below it, my risk is relatively controlled in a position like this. I think it's unlikely that in the next couple weeks we see INTC going down, 30% or so, without, some other major event happening. And so I feel pretty good about a trade like this. If I were to be putting on a short strangle, I would probably do something like the 20 strike put and the 23 strike call, which is not exactly delta neutral, but it's pretty close, right? We're selling the delta 31 call and the delta 26 put. It's about $1.50 wide on each side of the current stock price, and we would net about 80 cents for that. So we'd have a pretty wide range on that position as well, which is really what we're looking for. I think that strangle position also makes a lot of sense. So either of those trades really look pretty good to me. I'm probably going to go with the bull put spread since my portfolio consists of a lot of those right now, but I don't think you can go wrong either way, whichever one you pick. All right, everyone. So as you can see, I think there's a pretty good opportunity here on INTC. Is this something that I think you should be YOLOing your account on and going all in on? Absolutely not. This is definitely not a trade of that nature. This is just a little analysis that was done to say, hey, vol looks a little overpriced here. We should be selling options here as a part of our option selling portfolio, right? We should have lots of trades on like this. As we find them, we sell a bit of vol here, we sell a bit of vol there, not necessarily sizing this any bigger than I would any other trade. So there you have it. That's my analysis on Intel. I think there's a trade here today. I think it's pretty good. And let me know what you guys think. I'm curious to know what you think is missing from this analysis, if there's anything that you would like to add. And if you have any questions for me, just leave it as a comment in the video. It helps the algo if you leave a comment, so I will always ask you to do that. But in return, I will always reply to you as well. So thanks so much if you made it this far in the video, and we'll see you in the next one. Peace.